There's all different ways to trade the markets. If you're shorter term in nature, if you're longer term in nature, building a system that helps you to find your setups, it's not only helpful from my perspective, from a quantitative, systematic approach where it helps me to find what I believe to be better trades, but it also is helpful for sort of a keeping yourself in check, right? Building a system to help you find trades rather than just relying on your, spur of the moment thinking to find trades. So I'm a big advocate for being systematic in whatever you do in the markets.
What's up, everyone? Hope you're doing fun as always. Coming up today with another interview with TraderNick, one of the guys who's featured in our book, Prop Trading Secrets. Over here, you can check it out. Also, link below. He's one of the guys I really look up to in trading for really his transparency, but also really what he does. And he's actively in the market every day, managing different styles of trading full time for sure, and doing a bunch of stuff on the side too. Had the chance to connect with him on multiple podcasts before, where we discussed his trading style, his background, what things he had to go through, what challenges he had to overcome to become a full-time trader. And now today we talk more about, his day-to-day trading style these days, really what he's focused on at the moment. This podcast goes a bit more into advanced topics like option selling, like how to deal with volatility, and he shared exactly how he went through a drawdown in 2023 and recovered from it. This is a podcast packed with a lot of good advice from a really pro trader. If you want to read through his story, I recommend grabbing the book Prop Trading Secrets. It's available on Amazon and any other bookstore of your choice. You can check it out. I'll also leave a link below if you want to check it out. And with that being said, we'll dive into the interview right away. So welcome back on the podcast, Nick. Good to have you here.
Hi, Etienne. It's good to be back with you again. We've done several podcasts at this point, so always a pleasure to be back on and speaking trading with you.
Tell me what's been going on since we last spoke. I think it's been a few months, like 6 months or more for sure.
So things have been crazy in 2025. We've had a wild trading year. Things have been very volatile with obviously the change in administration in the United States and the Fed cutting interest rates and inflation in the last few years and all sorts of craziness in the economy. I think if you remember last time we spoke, or for those familiar with my content, I'm very heavily focused on the macro side of things when it comes to trading. What's going on globally, economically, inflation, jobs data, all that jargon that sounds like nonsense to people who don't care about it, but it plays an integral role in what I do and what I focus on in markets. So yeah, it's been 2025 has been a crazy year. It's been a really good year for me though, trading wise. Last year was pretty good. 2023 was pretty good. 2022 was a little bit more rough. But 25 has been for me a really pretty good trading year. I've primarily, stuck to what I know and love, which is trading, the indices, commodities, and a bit of currencies as well. So staying spread out across markets. And the volatility this year has been, it initially was very high. Obviously with 2025, we saw the Trump tariffs and the very volatile period that followed. And then now we've kind of sunk into a very low volatility environment in markets. So you had kind of a very interesting year throughout all of it.
Do you feel like volatility helps you, or is high volatility a good thing, or is it a bad thing for you in your case? And what happens when you have a low volatility on the other side?
Volatility is a fascinating subject in markets. And for options traders, people who focus on that very heavily pay very close attention to volatility, implied volatility in markets. I do a lot of options selling. I'm not sure if you're too familiar with the concept of options selling, or for listeners, but volatility can actually be a good thing in many ways. Widening volatility in markets can offer higher premiums if you're an option seller. And also just for non-options traders, higher volatility does mean opportunity. Volatility, you can get yourself into trouble because bigger moves, especially when you don't account for them, and your risk sizing can certainly work against you, just like they can work for you. But volatility in my eyes is generally a positive thing. It's where you get opportunities. If you're an investor, it's typically where you get better buying the dip opportunities for the longer term. If you're more of an active trader, like I said, option selling premium can get really good, but also breakout trades can be really strong. So I actually really don't mind either dynamic. And actually it's a good question, because I'm a believer that I think traders and investors should have something that sort of suits both time frame environments. So like if listeners pull up a chart of the VIX and you just say, hey, what am I doing when the VIX is really high? And what am I doing when the VIX is very low? At the time of us recording this, the VIX is really low. Like we've had just very small movements in most markets, we've really calmed down in recent months compared to the very large volatility swings we were seeing across the markets back in April. I think a big thing to think about too with the VIX is if you pull up the VIX, most markets in terms of correlation are broadly pretty correlated. Like currencies are going to move more at the same time that commodities and indices are moving. Now, of course, there are nuances and specific assets that will move larger if a certain story impacts them. But for the most case, right, most scenarios, volatility is pretty correlated. So I'm a big believer in having some kind of strategy or some sort of approach that suits both time zones or time frames, I suppose, when volatility is low and when volatility is high.
Do you have any rules when it comes to volatility or looking at the VIX? Do you have a certain level where you want to apply a high volatility strategy versus like a lower one? Or is it kind of that much of a rule? You kind of feel it more?
That's a good question. I think one of the things that I do in terms of like exposure is maybe what I use volatility for the most. So like right now with the VIX entering a very, very low period. I think I've got it pulled up here, 14.7 VIX, which is, it's a pretty low volatility environment. You have stocks sitting at their all-time highs. A lot of cryptos doing really well. A lot of AI stocks really exciting, pushing higher, doing phenomenal. And I love that, right? I love riding trends like that. I love, if I'm able to capture, upside momentum moves on those sorts of assets, risk-on assets, then I look to trail stops and kind of let winners run. On the trading side, I am predominantly a swing trader, and I mentioned I do trade a lot of indices and commodities. And so when they are trending like this, it's not something I want to fight. However, it's also not something I want to lean too heavy into. Like my sizing actually gets maybe a little bit smaller. I'm a little bit more conservative with new entries. Like I don't want to be piling in heavy positions right now to the NASDAQ or the S&P 500. Look, in a couple of years, that might be the right call. But from a trading perspective, I think there's a time to sort of sit on your hands and wait for dips, wait for pullbacks. And I think there's also a time to get a little bit more aggressive, especially for longer term buys. Like if I'm talking about, the opposite end of the spectrum, if volatility expands, usually, historically, that's a pretty good time. And I put some numbers to this, like a VIX above, let's say 30, most of the time over the longer term is a decent buy on the stock market. Granted, you're also working with a 15-year bull market that seems to never end, so you have to be a little careful with that conclusion. But at least in the last decade and a half, high VIX readings have been mostly pretty good opportunities to go out and buy stocks that you like. So that's a loose way of how I might use volatility to trade certain environments. I think that when you're in a low volatility environment, it's not something you want to necessarily fight. There's an expression, I think it goes, you don't want to sell a calm market, basically, just because, again, it can just drift, as we've been seeing here recently, it can drift higher and higher in that low environment, low volatility environment. And you also just have to sort of be prepared, knowing full well that when you're sitting at very low volatility, the outsized risk is the thing to switch to the other side, right? Where volatility expands dramatically and stocks and cryptos and all that risk assets drop very hard. So I think it's just being mentally aware that, good times don't run forever, bad times don't run forever either. And being not necessarily ultra contrarian, just, short for the sake that the VIX is low necessarily. I'm not advocating for that in any way. I just think being aware of risk to reward is ultimately what, volatility can do for you.
If you are enjoying this interview so far, then I think you'll like this one over here. I've been working on this book for a long time called Prop Trading Secrets. It's finally out. You can get it in your favorite bookstore or on Amazon, Barnes & Noble, of course. And this book is really about interviewing traders who are successful in either trading for prop firms or managing their own private fund. We talk about their background, what makes them successful, the things they went through, struggles they had to go through to become good traders now, and a lot of the good wisdom that you might not necessarily hear about, but it's all into a condensed version over here. You can read through these stories, get inspired, of course, learn a lot about what they do, their strategy as well. And we summarize everything at the end where we have a whole chapter of summaries of what these traders have in common. So if you want to check it out, 14 traders in this book that myself and Kathy Lean interviewed. There's a lot of good wisdom in this. If you like these interviews on YouTube, I'm sure you like this one for sure. Go grab it. Like I said, it's on Amazon, Barnes & Noble, it's on Audible in audio version. All the other audiobook platforms will have it too, or your favorite bookstore. So check it out. If you did read it, let me know in the comment section below which one is your favorite chapter, and we'll get back to the interview. I'm glad you opened the door to option selling, and that's something I kind of want to get into a little bit more. Is, do you sell option based on trades you have, like positions you already have, or is it like a completely separate thing that you kind of follow?
Yeah, so I do a little bit of a couple different core strategies that I've done for a long time. The primary one that I think is more flashy and exciting is my momentum strategy, which is essentially looking for pullbacks in line with macro fundamentals and sentiment. We discussed this in our previous podcast a good bit, I believe, just talking about how, from a momentum perspective, I'm looking for markets that are working really well, looking to buy on dips, controlled risk, defined risk with stops, and also at the same time trying to align myself with the bigger picture, the macro. I talked at length about how I've built a system around that, a software called the Edge Finder that I've discussed in our previous podcast. And if you're familiar with my channel, you probably heard me talk about it 1,000 times. It's a screening tool that I use to scan macro fundamentals, which play an integral part in what I do in terms of momentum trading. With option selling, it is interesting because option selling is fascinating in the sense that it is both easy and hard at the same time. With option selling, I do still take a look at macro. I still have a fundamental bias with whatever I am trading, but I do tend to do the classic wheel trading strategy, which is essentially selling cash secured puts out of the money, specifically on things that I wouldn't mind taking ownership or getting assigned. And for listeners who are not options traders, I understand this sounds like a foreign language, but essentially selling cash secured puts. When people want to buy a put or buy a call, there is also the ability in the options market to sell a put or sell a call, right? So a put is a bearish bet, a call is a bullish bet. You can sell bearish bets in the market and essentially take assignment if that bet hits for the buyer. So you're the seller. So if the stock, let's say you sell puts on Apple and Apple stock falls dramatically, that put that you sold, you have to kind of stand and take the collateral and essentially buy the stock from that put buyer. Again, sounds complicated. It really is not as complicated once you start practicing with it. Long story short, option sellers kind of play the role of a dealer within a casino because options typically are, how do I explain this as easy as possible, going back to volatility? Volatility is often overstated in markets. It's sort of like how there's like these unwritten rules of the market. Like, for example, stocks over the long term go up. It doesn't mean they have to go up every day, week, month, or even year. Stocks can go down for years in a row and lose 50% of their value. It's not an easy bet by any means, but it is a simple truth that over a large enough stretch of time, stocks tend to drift higher. Well, options volatility tends to contract over time. So options, because they are a time denominated asset, they lose value over time. Option selling is another sort of natural force in markets that can be taken advantage of. And so I typically like to sell options rather than buy them. There are people who make great money buying options if they have really, conviction, high conviction, trades or ideas. But I do typically sell options predominantly on specific equities that I like, so stocks that I like, and ETFs. And if I do get assigned, I will then convert it, usually once I see the stock has actually moved up a little bit, into a covered call position, which again is where you own the shares and you also sell a call against your position. The perks here of doing that, now pure wheel strategy is you have no timing involved. You have you're not trying to use charts. You're not trying to use any sort of analysis. Wheel strategy, the pure simple wheel strategy is you sell cash secured puts until you get assigned. When you get assigned, you start selling cash secured or covered calls, and you just keep doing that back and forth. I do a variation that is more analysis focused. So I'll sell cash secured puts when I think a stock is actually already discounted. If I get assigned, I wait for the price to go up to a point where I actually think it may start to be overextended to the upside. Again, just like I do with indices, commodities, and Forex, I have another screener that I use and have built specifically for stocks. It's called the Stock Box. It helps me to screen financial data sentiment data in stock market world. So, 13F filings, so institutional accumulation distributions, and also analyst rating. So I have like this algorithm that helps me to spot stocks that I like. I then, if I like the stock, if I do research on it, I'll sell cash secured puts on it until I get assigned. And again, wheel strategy goes from there. So, what it does, Etienne, that I really like about this, the reason I have this secondary strategy, is that it helps to smoothen out the performance of my other strategy, right? So selling options, typically, if you envision a chart that gradually goes up and then occasionally has big drops, that's essentially what selling options tends to deliver for people who do it well. And if you do it poorly, you can still lose a ton of money, just like everything else. But selling options gives me the opportunity to kind of have this smooth, slow and steady return with the occasional give back period where a trade, let's say you're selling a cash secured put and the thing just drops dramatically and you take a big loss on that trade. Like that's going to happen too. But that smoothens out the other style of trading that I do, which is where I take lots of little losses in the effort of catching the big momentum winner, which is not that frequent, but when it comes along, it pays out pretty big. Currently, at the time of recording this video, it is September here, and I am currently long silver. I've got a trade that is running super well on the momentum side. I've been able to trail my stop like 5 or 6 different times on the 4-hour time frame. The trade is like, I want to say it's like a 5 or 6 R right now, 5 or 6 times my initial risk on the trade. So it's been a phenomenal trade. But I don't catch those sort of trades every single day. Every once in a while, I'll catch a really great runner. But what's nice is in the background, I also have option selling, which is sort of this, slow and steady, secondary, more mean reversion focused strategy.
That's a good point. Option was like one of my main focus this year to kind of understand and master. So I'm glad you definitely talk about it. It's good. The risk though is like if you have like you mentioned, you have a stock that you buy eventually from a put, and then you kind of have to. Do you feel like the premiums you sell on the covered calls, are they enough to kind of keep the risk in check, or can you have the stock kind of completely go down and you lose a lot of money on it?
Yeah, well, that's the thing with selling options on anything. The options market is pretty dang smart, so it prices volatility decently well. And so what I mean by that is that if you are selling puts and calls on the S&P 500 ETF SPY, the nice thing about that is that you don't have the possibility of the stock market one day opening up down 50% like a stock could, right? If you're selling puts on a stock and that stock opens up the next day down 50%, it can be devastating, especially if you are using some sort of leverage or high, amount, selling a lot of contracts or something like that. So, for me, with the option selling, I do so with very little to no leverage. Like I'm not selling way beyond the cash in my portfolio. Essentially, I truly do cash secured puts, right? So I have the money sitting in my bank or sitting in my account, available to be assigned. I'm not a big fan personally of dipping into way beyond your buying power. Perhaps in the future, I'll find more creative ways to get smarter with buying power when you're selling options. But yes, there is the unspoken risk to selling options is that if you sell options, you do have the potential to get assigned and lose significant amounts of money if you were to sell a put and the stock were to crater, or you were to sell a call, a naked call is what they call it, where you don't have any sort of ownership in the stock. If you were just selling calls out of the money and then the stock just blows through that call, you can lose a lot of money. So again, nothing in trading or investing is easy. And option selling, the other thing is that if it's lower risk in some ways if you aren't using leverage, right? Because you're only getting assigned at lower prices, you're collecting premiums in the meantime. It has a lower beta to buy and hold. However, but it also comes with the drawback of typically underperforming in a bull market, right? So if the market's just shooting straight up, you're better off just owning the shares rather than trying to sell options on them. So pros and cons with everything. Part of the reason I like to spread out into option selling is that I don't think the stock market's going to go up forever. And I do think that you are going to have downturns, recessions, pullbacks, and that adopting some level of option selling can help to smoothen during that period.
What's for you a good stock to sell options on, like to sell puts on?
Yeah, it's a good question. So I mentioned earlier that I have a specific software that I have built that helps me to screen stocks. So it changes. When this year I've done a lot of option selling on Google. So it's a company currently at the time of us recording that I really like. Earlier this year, I thought that the stock was not necessarily, I don't want to say undervalued, but it was really hated because people were thinking, Google's going to miss out completely on the AI trade and all the chat GPTs of the world are going to take over Google search and all these things. And I felt that the stock, just from an anecdotal, if just from my opinion on the company, was getting overly thrown out. But even looking at the financials, looking at PE ratios, looking at forward PE ratios, the stock on a relative to its historical basis was trading kind of cheap. Not necessarily cheap on an absolute terms in terms of the company's valuation, but cheap relative to its 3-year average, which is what I typically use in terms of trying to gauge if a stock is expensive or not, is I look at a wide range of financial metrics. And I don't do this manually. I do this automatically with the software that we've built. It's called the Stock Box. And so I have tools for everything that I do in trading. I'm a software engineer by trade, so everything that I do is built around being a systematic trader. I should say a semi-automatic systematic trader. I know the flashy thing is to be the fully automated, don't even look at my trading and I just sit on the beach. But I'm a market junkie. I'm staring at this stuff all the time. I love this stuff. I love building tools around it. So that's what I do. I mean, I have a screening tool that helps me to spot stocks that I think or that the system has been coded to spot. And again, I think that every trader in today's world should be systematic, whether it's using a software like ours or building your own or finding something else in the internet. I think it's the way to go, is to have systems that are helping you to spot ideas based on a curriculum or something that you're comfortable in. There's all different ways to trade the markets. If you're shorter term in nature, if you're longer term in nature, building a system that helps you to find your setups is it's not only helpful from my perspective from a quantitative for a systematic approach where it helps me to find what I believe to be better trades, but it also is helpful for sort of a keeping yourself in check, right? Building a system to help you find trades rather than just relying on your spur of the moment thinking to find trades. So I'm a big advocate for being systematic in whatever you do in the markets.
You mentioned Google is definitely a good one. I would say Walmart is another one to my list. Walmart is really good for options.
Yeah. No, I mean, that's the thing is, just from a current perspective, I sold puts on Google. I got assigned and I felt great, got a great buy on it. And Google at the time of us recording is trading here at 240. I sold covered calls at 215. So I am essentially, I own the shares. I sold the 215 strike price out. I think it's got like a week left on it. So I'm going to get called away from the shares, which is not ideal. The stock has basically ripped higher. I'm not going to lose money from that because it's a covered call, which is hypothetically, you cannot lose money on a covered call. You just can forfeit some of your upside, right? So I've forfeited some of my upside. Stock has ripped higher here. So again, there's pros and cons. With hindsight in my favor, I would have been better off just owning the shares and not selling any calls on it. But hindsight is obviously 2020.
I want to go back to something you mentioned about systematic trading, and I think it's a good point. What we tell someone who says that you need that kind of discretion to be able to make good money trading. You need that kind of like discretion, like that skill to be able to make money trading, and you cannot do it just with systems.
Yeah, well, actually, I agree. I think that systematic trading does not necessarily mean 100% mechanical. In fact, what I do is definitely not 100% mechanical. There's a level of discretion and intuition that comes into play in what I do in terms of trading. But I think that I would say probably like 80%, 85% of it is purely systematic, where it shows up on my screeners. I pull up the chart. I do, my analysis. Essentially, I'm looking for if I'm, for example, my momentum strategy. If I'm looking for momentum, I'm clearly just looking for a pure technical. You can define those with rules. You could however trader might want to do it. You could put moving averages. I think there's many ways to spot momentum, right? But then making sure that it also, if we go back to what I do on commodities, indices, and FX, I'm looking for the macro to line up. That is pretty systematic, where I have a system that will check, for example, the latest jobs reports from the U.S. Look at CPI readings like we got today, the producer price index numbers. It's looking at interest rates. It's cross-checking all of these things and systematically telling me red light or green light in terms of, do these things look okay? And if they do, then I can use a little bit of discretion to say, okay, well, let me look at this technical chart, find an entry. Where the discretion, I think, can get you into danger is, I think if you're just going purely off of discretion, it's very easy to see stuff that's just not really there, or take a trade out of boredom or things like that. I'm not a huge trading psychology guy. I know that's very popular for people. Oh, you got to stick with your system and discipline. And I know all that's important, but I do think actually the most important two things, there's three things. Discipline is one of them. But I would say what most traders lack is actually more heavily on the finding a good trading system, an actual system that has an edge, that generates more profits and losses. I think a lot of traders fool themselves into thinking they have that without actually doing any sort of back testing, research, or discovery to build systems like that. There's a lot of work that goes into building systems behind profitable trading systems. It's a lot of work, and as you know, Etienne, and listeners who probably listened to a dozen of your podcasts before, you'll keep hearing this, right? Systems and building systems that have edge is both difficult but also critical. And the other thing is actually truly diving into and thoroughly studying risk management, like actually knowing how to keep your account from blowing up. Because even if you have a good system, you can mess it up with too much leverage, with one bad losing streak where you're not, where your sizing is inappropriate. That was, a painful lesson for me getting started, is like I finally, would do all this back testing, find a system that actually worked pretty well, and a couple bad losing streaks would send me into just a horrible drawdown. So it's very easy to make the mistakes of, I actually think that the biggest thing traders mess up right off the bat is they put too much size in their trades. Like, size is almost always the problem. For listeners who are struggling, like I will tell you right now, I've spoken to thousands of traders. Etienne, you have obviously as well with your podcast, thousands upon thousands of traders. And the most consistent problem that I see poking up in people's reasons for losing money, it's almost always a problem with position size. Like, it's almost always that their size is too big. Now, if you don't have an edge, then yes, you're also going to lose money. But if you have bad risk management, you're just going to blow through money. And so that's the first problem that I think people really need to focus on, in my opinion, is risk management. But then, again, going back to the trading psychology thing, trading psychology and having discipline in your trading is certainly important, but that's like stating the most obvious of anything. You want to be good at anything, you got to have discipline to do it, right? That's not really what I think holds back traders from reaching their potential. I think what holds back people from holding their potential or reaching their potential is that they actually lack systems, edge, and risk management. I think that if you actually take the time to study something, test something, build something, and throw it against market data, that's going to give you a lot more confidence in what you're doing and fix a lot of the trading psychology issues. That in combination with proper size. Like, if people are feeling scared in their positions or they can't sleep at night because of their positions, that's a risk management problem. That's not a trading psychology. Your size is too big, right? Like, fix your size, and then most of your trading psychology issues that you think are holding you back, they'll just start to dissipate because it was ultimately just you're gambling. Your size is too big. If your size is too big, it doesn't matter what your system is, you're going to blow up eventually. So again, I think that one of my more controversial takes is that trading psychology is a bit overrated, and that I think more important than trading psychology is building a system and proper risk management and position sizing.
Can you actually teach discretion, or is that something that needs to be developed by someone on their own?
I don't think you can teach discretion. I think it's experience only. I think the only way to truly learn how to sort of if you trade gold every single day for the next 5 years, you're going to start to pick up things on gold that are not like explainable in words. It sounds like a gambler's fallacy, like, oh, if I stare at the roulette wheel long enough, I'm going to figure out. But these are not totally random events, right? When we're talking about markets, there are certain behaviors of precious metals. There are certain behaviors of currencies. There's certain behaviors of indices and stocks. Like, there are certain things that you do just pick up on through repetition, through experience, and through staring at them long enough. So I don't think that I don't want to overhype how much of it is discretion and on the spot intuition for trading, but I do think it is important that you pick your areas that you want to study, that you really do the research on them, and that you take time with demo accounts. Eventually, maybe when you're ready and you've actually tested systems to start employing them on very small trading accounts. But I do think there's no substitute for experience.
Totally agree with you on that. I think you can teach it, but not fully to the extent where what you've developed yourself for many years of experience, for sure.
Right. Definitely. Yeah, I think it's again, you can pick up on things. I always say in my videos, like, I can't teach you everything that I know. I can share with you everything that I know about markets, which I feel that I know a good bit, but I have plenty more to learn because there's just endless amounts to learn about the financial markets. They're never ending. They're always changing. They're very dynamic. They're very complex, and there's always people that know more than you. So that's an important distinction, is to recognize that you don't know everything about the markets. But then even in my videos, I can share everything that I've learned through videos. But watching videos and listening is just never going to be the same thing as actually doing the thing. Like, if you're talking about like learning how to ride a bike, you could watch 5,000 videos on how to ride a bike, but until you actually get on a bike and start riding a bike or trying to ride a bike, there's some inexplainable muscle memory things that can only be developed by actually doing it.
You mentioned having a really good year this year in trading. Last year was also good. 2023, you had a bit of a tough time. You want to go back to kind of what happened then and how you recovered from that tough time 2 years ago?
Yeah. So in terms of 2025, I went into this year with going into the elections. I was pretty cautious because people were very euphoric. This is not a pro one way or the other political thing, but elections have an interesting thing where they typically, there's like a run up to the election announcement, and then in gold prices, right? For example, so gold prices, I was really long going into them, and then prices drop off. So I had a really good trade in gold couple times in the early portions, or I should say late portions of 2024, and then in 2025. After Trump had been announced the winner and the markets just took off to the upside, I was sort of priced out, as I kind of am currently, where I think stocks started to get expensive. Everything was sort of overstretched to the upside. I wasn't looking to short the market, but I preferred gold because I thought that there was more upside potential in going to alternatives like gold. And so I bought a pullback in gold at that time, and it just ripped in my favor, which was amazing. And again, it's easy to talk about your winners. So I'll talk about 2022 in a second, which was a much tougher year for me. But in terms of 2025, I then stocks got really cheap in the sell-off. So when we started breaking out to the upside after the April sell-off, I was able to start getting long. I had some great trades on like the Russell, for example, and a lot of individual stocks I did really well with this year. So 2025 was a really good year where I was able to capture some momentum in gold initially, and then in stocks later. And now I'm kind of back in the metals trade currently. But when it comes to something, a tougher year like 2022, what was the issue? Well, I do have a tendency with what I trade. I'm more of a swing trader, not necessarily super long term, but I'll hold trades for a couple days to a couple weeks. And in 2022, the market was pretty bearish in terms of the stock market itself, right? So stocks were down quite a bit in 2022, especially tech stocks. Tech stocks, I think the NASDAQ was down like 30 something percent, 35% or something like that in 2022. So you had a pretty good sell-off in markets. I personally on my account had about a 30% drawdown in my account in 2022. And during that time, what was not working was a lot of my momentum strategies I'd be waiting for. I typically don't short indices very frequently. So that year, a lot of the long attempts that I would wait for, right? So we'd get a breakout to the upside, price would pull back a little bit, and I'd be looking to join the move. There were several instances in 2022. If you pull up a daily chart of the S&P 500, there were several kind of false starts to the rally. And I think that if I were to do it differently, obviously with hindsight, in a bear market, rallies are pretty dangerous, right? Like rallies can be very sharp to the upside all of a sudden in bear markets, but they can also be sold into really aggressively. So in 2022, I had several sort of fake breakouts that kind of caught me on the wrong side, and I ended up taking a pretty good losing streak. Like a lot of trades just were not working out during that time. At this time, I was also trading commodities. I had some trades on gold that just did not pan out. I had some oil trades that were tricky. And so, that was just a tough year for me. A lot of the tech stocks that I had been holding from the year before also took a dive on me. So it was a combination of a bunch of things, but I ended up taking a pretty good drawdown that year. But then, when I talk about this on my own channel, I have a video on my channel where I've gone through my entire brokerage statements from 2020 when I started this public account all the way until now. I'm a big advocate for transparency. I showed all the upsides. During that year, it was horrible. In terms of being a social media content creator, it's no fun to go through a 30% drawdown in front of everyone. Trust me when I say that. It is hard enough on your own. It's really hard when you have know-it-alls telling you should have done this and you could have done this. No fun at all. But in 2022, I stuck to my system. Like I didn't change anything I was doing. It was a very hard year. Not to mention, psychologically, it was difficult. I was also getting married that year. So I had a wedding that year. It was just a busy time in my life. It had no impact on my trading specifically because I'm not, saying like, oh, I had a bad year because of that. No, the market was down and my system works worse in a down market. I think knowing your strengths of your system or not is important. The option selling, I wasn't option selling in 2022. So that is one thing that I do hope that if we see another bear market, that will help to smoothen out. I do all of this trading that I'm talking about in one main portfolio that I track publicly on the internet, on my YouTube channel, frequently. On my live streams, you can see me trading it. I have a public brokerage where I track all my stuff and I share it online. And so I do my option selling in there, and I also do my momentum trading in there. And so the reason I do that is so that you can kind of see the smoothened out performance. I also do these things in individual portfolios, other portfolios that are not necessarily all public. But for the public portfolio, I do both my option selling and my momentum trading in that account with the hopes of kind of getting an idea of the overall performance. Everything's smoothed out. So my hope is that next time around, when you do get a bear market, because it's going to happen again, it's not a question of if, it is a matter of when. Some people believe nowadays that can never happen again and that the Fed's going to, save the day forever. But I don't buy into that. I think that you will get bear markets. I think that good times don't last forever. And I'm not a doomsdayer. I'm just trying to be prepared for what is, I believe, a mistake to think that stocks can only go up, risk assets can only go up. So next time around, long story short, how would I better be prepared? Well, I'm hoping that option selling and spreading my risk, not just all in tech stocks or not just in crypto, like a lot of people currently are doing, I think will hopefully help me to survive a downturn in the market. Again, I don't think that that's necessarily happening tomorrow, but I want to be prepared for it because I see a lot of people nowadays, Etienne, that are like, oh, hey, stocks only go up, crypto only goes up. And it's the greatest, repeated cycle in markets you ever see. As you see, when the market's in a bull market, everybody is a genius, right? That's the old expression. Everybody's a genius in a bull market. And then when the market turns, people get wiped out. And so I am a big fan of trying to be prepared, diversifying both in asset classes and strategies to better prepare for a different market cycle.
I think the key thing is people are trying not to go to these tough times in trading. They try to avoid them, but going through them is inevitable. It's going to happen one day, and you got to know how to react to them and how to get back on track. So I'm glad you shared this too. It's good.
I think nowadays, young people, and it's not necessarily their fault. But I think that a lot of young people, and we are young people, so we're in this category. They want instant gratification. They want to make quick money. And who's to blame them? We live in a very expensive world. It's a really challenging time. People crave the idea of being able to flip an account or chase prop firms and make a lot of money there. And not to say that these things are necessarily wrong, but I do think that, look, trading is not instant gratification. It's just not. It's drawdowns are a real thing. You may have a great system that works in the next 5 years, but you might have 1 or 2 of those years that are awful, and that's just part of trading. And so I think that getting used to that not only is important in trading, but it's very similar to like entrepreneurship, where like if you're running your own business or you're doing something for yourself, you don't get paid every week on Friday or every other week on Friday. Like you can go to work as a trader for 3 months and come out negative, and that's a really difficult thing to get used to. And so I think that's people get used to the environment that they're into. There is recency bias in markets. So people see NVIDIA going up and they're like, I got to own NVIDIA because that thing goes up all the time. And it is a very easy trap to fall into and get kind of sucked into, is this idea that what has been is going to keep going. And, crypto's, every few years it quadruples, whatever, and just believing that is how things always go. But there are numerous examples throughout history where that line of thinking would have completely destroyed your performance. And I think one of the most dangerous things you can think to yourself is, well, this time it's different. That's like the famous last words in financial markets, is believing that this time is different. This time the Fed will never let the market crash. Or this time AI is going to make companies so efficient and it's going to melt up into the heavens, and we are never going to see a down market ever again. And I think that's just a really dangerous line of thinking. But it sometimes it's a natural thought. You're like, wow, the stock market never goes down. And again, I'm not bitter about it. I'm very long on a lot of stocks that are doing great. But I just think it's important to be prepared for what could be a market change at any moment.
Totally agree. Tell me where people can find you and connect with you after this podcast.
Yeah, so you can find me on my YouTube channel, TraderNick, or if you want to explore the tools that I mentioned in this podcast, you can go to our website. That's a1trading.com, the number one trading.com. You can explore the tools that we build over there. We build screeners for all sorts of stuff, and that's where I spend most of my time.
Good stuff you put out there on YouTube. A lot of good content on social media as well. So I definitely appreciate that. Hopefully we can catch up with you and talk trading soon again.
Absolutely. Thank you very much for having me, and love your podcast. So thanks to the viewers for listening.
So there you have it. I'm really happy about the way this interview turned out. We didn't plan to discuss option or anything of the sort. It was a good topic to talk about. If you want to learn more about option selling, something I've also been doing for the past year and a half or so, and something I'm really working on to become better at, comment below with the option. If you have any question for me or for Nick, comment below with your questions as well. I want to hear in the comment section too what advice you took away from this, what you will apply from this interview. I read all the comments. I reply to most of them. And hopefully you got a copy of Prop Trading Secrets. There's a lot of good stuff in that book. Definitely going in depth into the stories, the mental struggles that traders had to go through, and what really makes them successful today. It's been a blast to interview these traders and to write about them. And I hope you get to read it. Make sure you are subscribed if you haven't done yet. I have an interview like this every single week on Sundays and Monday on the podcast. And I'll catch you back here in the next interview pretty soon. Ciao.